In this video, we're going to continue talking about how to select stocks that you want to invest in. What's going on, people? It's your boy Kelechi back with another video. I hope y'all are having a wonderful day. But last week we talked about fundamental analysis and how to select stocks, and we're going to continue that conversation today. Remember, last week we talked about how there are two parts to selecting a stock when you're looking at the fundamental analysis of a company. One was the qualitative analysis, and the second one was the quantitative analysis. And the qualitative was all about the Mamba mentality, special sauce of that company. Remember, we talked about how we're looking at the Krabby Patty and what's the special sauce of that thing. And basically, this time around, we're going to be focusing on the quantitative part of everything, which is the hard details. It's the dollars and cents that follows that business. It's the underlying things that we're going to be looking at today. Remember, when we talked about the qualitative side of the business, we asked 3 different questions. The first question was, do you understand the business that you're about to invest in? The second question was, does this business have a competitive advantage? Or as we talked about last week was, does it have an economic moat so that other people can't compete against it? And then the third question was, what is the management team like? And then we talked about how each one of those questions are connected to each other. But anyway, this time around, we're going to be talking about the quantitative part of that analysis. And we're going to start off with a rule that I think every single one of us should always remember when it comes to investing. And that is the rule by Warren Buffett, which says, never lose money. That's rule number 1. And rule number 2 is never forget rule number 1. That's a rule from Warren Buffett that is very important. And the reason why I say this rule is so important as we're going more and more into this is for you to understand that when you select stocks, you're selecting businesses. This is why it's important for you to look at the business aspects of those businesses, aka the numbers behind those businesses. So anyway, the first thing you're going to look at is something called the annual report or the 10K report. Now, this is not that hard to find. This is something that you can go on Google and search what is the 10K report for Apple or annual report for Apple, anything like that. And basically what the annual report is the financial record of the company. Basically, it tells you exactly how the company is doing. It tells you all the ins and outs of how the company has performed over the year. And you want to compare those reports year over year. You want to compare, is this business doing well or is it not doing well? Now, your question may be, wait a minute, why do they make these things publicly available to the public, the inner runnings of a company? Well, the thing is, the Securities and Exchange Commission, aka the SEC, requires any business that's going to be traded on the stock exchange to reveal their books, to show their books so that investors can know what they're investing in, if that makes any sense to everybody. So that you, when you're trying to say, am I going to invest in Apple? Am I going to invest in Microsoft? You can make that decision with your eyes wide open because you can see all the financials and all the finances of that business. So the first thing you're going to look for when you go into any of these annual reports is something called the income statement. And simply put, the income statement has everything that you're going to be looking for. It tells you how the company is making money, where it's making money at, and some of the things that it has to pay for. And the first thing you're going to be looking for within that income statement is the revenue. And what is the revenue? The revenue is the amount of money that the company is bringing in. Think of it as the salary of the company. Think of it in personal finance terms as the salary that you bring in every single year. So basically, the revenue of the company. This is very important because you need to know, does this business attract money? Does this business continue to grow its revenue year over year? Is it able to attract more money to come into the business? This is very important to make sure that when you invest your money, you're not investing your money into a dying company. The next one is called operating income. Now, something that I have to make as a note to everybody is, for some reason, financial experts have decided that income and profit are the same thing and they use them interchangeably. So when I say income, I'm also referring to profit. I don't know why they decided this. I don't know who they were trying to confuse when they decided these things, but I'm just gonna tell you what it is so you guys can learn it as well. But anyway, operating income. This is the profit generated from the regular operations of the company. A better way to think of net income is think of when you get paid and then you have like birthday celebrations, you have like tax payments you have to do, you have to renew your tag on your car, those kind of things. Those are one-off things. In the operating income or operating profit, this just eliminates all those one-off things, all those purchases or all those acquisitions that they may have made that is a one-off acquisition. It eliminates all that so you can see exactly how much profit is being generated from the sales of the company, from the items that the company is generating in and of itself. And this is a formula of how the operating income is generated for anybody who cares out there. It subtracts from the total revenue, the cost of goods sold, and the operating expenses. Think of it as like subtracting the wages, subtracting those kind of things from the income, that the revenue that is being generated. The next one we're gonna get into is net income. And net income simply is the final dollar amount after everything else is removed. Just think of it as that final balance on the books. Think of it as you have paid off all your bills, you've paid every single thing for the month, and it's the remaining money that you have for you to do whatever you want to do with it. Whether it's to buy yourself some new shoes, buy yourself some extra to go out and eat, buy yourself a new stock, anything like that. Basically, it's the same thing for businesses. The net profit or net income is the final dollar amount. When you're looking at an income statement, it's going to be the last number on that income statement. And for anybody who cares about the formula for this thing, this is what the formula looks like. It is basically net total revenue minus total expenses. Simply put, that's your net profit. Now, to bust everybody's bubble and to help you understand something before we get into the next part of this video, profit does not equal cash. I know, it blew my mind the first time I was learning about this. Just because a company is profitable does not mean that the company has cash on deck. You get what I'm saying? It's kind of like us as well. Just because I am living okay at home and all my bills are paid does not mean I have extra cash in my bank account. It just means that I paid all my bills and I'm getting by. It's the same thing with companies. Just because a company is profitable does not mean that it has cash on deck. And so to better understand cash flow, you have to go to the cash flow statement. And the first thing you're going to be looking at in the cash flow statement is something called operating cash flow. This is the amount that the company or business needs to run day-to-day activities. In other words, this is an amount that the company always has to have on deck so that it doesn't have to go out there looking for loans in order to run its operations. And this is very important for us to pay attention to, because this tells us if the company is doing the right things all the time or if the company is just kind of getting by every single month. That's what the operating cash flow tells us. And then the final one we're going to talk about today is something called the free cash flow. This one, for anybody who's a dividend investor, is very important because this is where we get a little bit of the company. This is where we get paid too. This is where we earn some of those sweet, sweet, sweet dividends from companies. We pay attention to the free cash flow of the company. But anyway, this is all I'm gonna cover for this one right here, because it's a lot more that I can go into. We can talk about the return on invested capital. We can talk about the PE ratio, how to study that and why that is important. There's a lot of other stuff to talk about, but because I don't want this video to be too long, I'm gonna cut it off right here. As you can see, it's a lot of information in here. It's a lot of information that you have to look at when you're determining if you're gonna invest in a company. This is why I am always gonna tell everybody, invest in an ETF. It makes your life a whole lot simpler. Like we talked about, I think it was 2 weeks ago, on the fact of how to look at ETFs. Simply, you look at the ETF, you look at how much fees you're gonna be paying on it, what is the ETF tracking, boom, you're done. And for this one, there's so much you gotta be paying attention to. You gotta be looking at all the time. That's the hard work of being an active investor. You have to be paying attention to all the companies you own like this. But anyway, that's all I got for y'all today. I hope y'all learned one, maybe two things out of this whole thing. And I'll catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace.